Welcome back to another episode of the Lender Podcast. I'm Bryce Matheson, and as always, this episode is brought to you by Lender. Lender is a loan management software tool designed to help you with every aspect of your business, from origination to servicing to payoff. Lender helps you with document generation, helps you with collecting monthly payments, dispersing monthly payments to your investors, taking in new loan applications, giving your borrowers a portal that they can log into, giving your investors a portal that they can log into. Pretty much every aspect of everything that you do inside of your lending business can be done and facilitated through Lender. You can check that out by going to joinlender.com. That's LENDR, joinlender.com. Now, on to the episode.
Hey everyone. Okay, similar to last week, this week's episode is another panel episode from the Paper Trail conference that I attended just a couple weeks ago. And this one is talking all about funds. And my goodness, this just about knocked me off my seat with all of the advice and different things that both Kevin and Gerard were hitting us with. So to be honest, I don't know why I was on this panel, because these two are just like brainiacs and I felt completely incompetent just sitting next to them. But regardless, it was an overload of value. So both Kevin and Gerard, they kind of introduce themselves and go over kind of their expertise and everything. But Gerard, he's been on Wall Street and has run many different hedge funds. Kevin works with Fortra Law, which is kind of a spinoff of Gerasi Law, if you're familiar with Gerasi. And he does everything from fund organization to compliance to regulation and all sorts of different kind of stuff. So if you are in the process or considering switching to the fund model, definitely check out this episode. It is a treasure trove of information. So just a couple high-level details. We will kind of go over some of the legal structures, compliance, and fund formation, talking about Regulation D, 506C, go over like Regulation A, crowdfunding, things like that. We also go over capital raising, investor relations, also talk about operational and management challenges with running a fund and some of the complexities, different investor types and risk management, risk mitigation between just all sorts of compliance, things like that. And then also we talk about strategic decision-making, talking about when and why to start a fund, when is the best time for you. Anyway, again, it is a wealth of information, a little bit long, but I promise you all of the information is incredible. Also, bear with me on the audio. Again, this was recorded on my phone and then I ran it through kind of an audio enhancer. So people on the far end, they do sound a little bit robotic. Also, some of the questions from the audience might be a little bit difficult to hear, but bear with me. The audio may not be great, but the content is invaluable.
So welcome to taking the fun out of funds. And I guess according to a couple people this last couple of days, I've been a bit of a Debbie Downer, but it's not because It's not because I'm not optimistic about the market or what we're doing. But I always am trying to take the counterpoint of the cautionary tale, because there is so much guru and pomp and circumstance about all these great opportunities out there, and people will whet your appetite with all the wonderful things that are available to you as an investor, and they don't tell you the downside of it. So Kevin and I we talk a lot about all of the hot topics of funds out there, a lot of the YouTube videos, and I'm not that I'm down on people like Bridger Pennington or Pace Morby, but it's hard when they put an 8-minute video out there on why you should start a fund and how easy it is and how he got started. But he also had a dad who ran a fund and a brother on Wall Street. And I don't have that. So most lay people can't just go and stand up a fund and do it the way that they tell you on a 8-minute YouTube video. So really what we wanted to have is a really lively discussion here. And it's good that we have 2 hours, just because I think you can run really deep on the topics of funds. The challenge that everyone seems to talk about is I can just set up an LLC and do it. Raising capital is the hardest part. What I have found after launching a fund and running a lending business for 8 years before I did so, managing it is much harder. Managing the capital once you place it into your fund is a real significant undertaking. And you either have the expertise in the background to do it or you don't. And I find that it's pretty difficult to learn on the job without support. So this whole conversation is with some folks who are very experienced in funds, either from the legal and compliance side, as you've heard Kevin from this morning, and he'll give a little bit of a deep dive in the variety of funds that are available, different type of offerings and some compliance and regulatory considerations before you set it up. Gerard and Bryce have both managed funds and can give you some experience, some guidance on the core considerations when managing strategy and operations when it comes to managing a fund on a day-to-day basis as well. So we'll just start by introducing ourselves and a little bit about our background, and then we'll jump in.
Gerard Figurelli. I manage the L2L fund, which is Matt and Beth's, the fund underneath their business. God, I was trying to figure out if I said it yesterday. I think about 13 years. I've been in the hedge fund business, everything from qualitative research to algorithmic-based quantitative research. We've had funds that were private equity, private debt, you name it, public stock trading, been around it all. And I think part of what we're going to get to here is the thesis can always change, right? Whether it's private debt like we're talking about today, but the hedge funds at their core are a structure, right? And so regardless of what the thesis is, they have a lot of similarities in public securities. Maybe the investment thesis is very different, but what I've learned is a lot of the foundational pieces you need from risk mitigation to corresponding with clients to raising capital, a lot of those things all are the same across all asset classes. Perfect.
My name is Bryce Matheson. I run primarily two different companies. We have our private lending company, which is Holbrook Capital, and then we also have a software company for loan management, origination, and servicing under lender. I kind of feel like the odd man out. We do operate a fund, but I definitely don't have as much experience as these guys do. Just my own understanding from going through the process and doing that myself. So, yeah.
Hey guys, Kevin Keenan, partner at Fortune Law, lead the firm's corporate securities practice, an expert in fund formation for private lenders. I also do it in real estate and a few other industries. I also teach the American Association of Private Lenders Certified Fund Manager course. I've been doing that for a little while now. And we represent private lenders of all shapes and sizes, from as small as your local broker to as big as this BlackRock, right? So the industry's grown massively, and so we're excited.
So I'll be starting with you then, Kevin, if you can just give us a brief tutorial on the different types of funds that are out there. You talked earlier this morning about Chris's Reg A fund and how that's different and can accept non-accredited investors. There's Reg D.
Yep.
Why don't you talk about the different type of fund offerings and the variations of each?
So there's kind of two buckets we're trying to figure out in the world of fund, right? So we're going to stick in the private side. We're not talking about any public, right? So there's the exemptive framework. So this is the securities law that you're relying on to offer and sell securities exempt from registration with the SEC. Right. So in that bucket of thought, we have to pick an exemption based off what the sponsor how the sponsor wants to raise money. Regulation D, is an exemption. That's a federal exemption. It's highly, highly used in all industries. It's comprised of three different types of exemptions underneath it. One I will not discuss because it's never used. And there's two that are commonly used. 506B, as in Bravo, 506C, as in Charlie. Okay. Very popular, right? So it's probably the most popular security exemption used today. Several $1 trillion have been raised under these two exemptive frameworks. 506B is your prototypical friends and family exemption. It allows you to have 35 non-accredited investors in your offering, as many accredited investors as you'd like. The accredited investors can self-attest to their accredited status, but you are prohibited from marketing, advertising, or what's called general solicitation of the offering. I mean, you cannot promote the offering publicly. You cannot go to someone you met today and say, hey, invest in my fund. That's called general solicitation, right? 506C came out with the Jobs Act during the Obama administration when they're trying to revamp capital markets, and it allows for marketing. It allows for general solicitation. It allows for all kinds of fund marketing activities, but you are limited to verified, accredited investors only, right? So that's the stick and the carrot, right? The rules on verification are kind of stringent, right? So you have to verify the investor status either yourself by getting a couple different forms of financial records, or you get a letter from a CPA, attorney, broker-dealer, or investment advisor. I advocate for the letter. The rules have changed recently. I've been loosened a little bit. So now if the investor's ticket size is $200,000 or more for an individual, $1 million or more for an entity, the verification requirement goes out the window. But the investor must test to you, the sponsor, that they have not financed the investment. That's a very important caveat to that new rule. That's the most common, right? Now, there are state level exemptive frameworks that a lot of people use. Like if you are raising money in one state, all the investors live in that one state, you can look to state law. In today's marketplace, I don't see that being a very viable solution anymore, especially post-COVID. People have moved all over the country, right? It's just everywhere, right? So it doesn't really help us anymore. I don't really go over state exemptions anymore these days. Regulation A. Regulation A is basically a public offering. So for those of you who heard the idea of it today and got interested, I will tell you it is probably 3 times the cost of running a Reg B. It is a public offering, meaning that your offering has to be approved by the SEC. You have to constantly amend your offering with the SEC. You have to report to the SEC. You have to have a broker-dealer attached to you to comply with state-level regulations. You have to have audited financials. It is not for the faint of heart. I do not advocate Regulation A, Tier 2 for anybody unless they have experience running offerings. The key components of Regulation A, Tier 2 is that you can have as many non-accredited investors as you like. You can market all you like. You can even allow for secondary transfers all you like. You are limited to $75 million every 12 months under Tier 2. Max cap 3-year run. As to requalify it, but you have to amend it every year with the commission. So your legal bills on this kind of program is going to be significantly higher, right? And there's a lot of small firms that claim they do it, and they don't do it very well. I've had to take those programs and fix them because they like to tell the sponsor, the SEC requires you to file every year what's called a qualified amendment. That's important, and if we could do that. And so there's a lot of that issue going on. These are the 2 commonly used exemptive frameworks in securities. That's the exemption arena. Then you have, what am I offering as an investment? Like you said, right? What is the actual investment? I hear the word debt fund thrown out a lot. And the problem with the phrase fund is nobody really understands what the word fund is, right? When I say fund, when I talk to my colleagues, fund means you're offering an LP position or an LLC position, ownership position in an entity, right? And you are pooling assets and making a return and distributing those profits through a partnership taxation model, right? That is a fund. What a lot of people throw around as a euphemism is a note offering, right? Chris offers a note offer. They have a note program. They offer debt instruments to their investors as a security, right? That is totally fine too. That exists. But you have to very much be clear what you're offering. You tell me debt fund, and when I find out you're doing notes, it's a totally different thing, right? The structures are different. The economics are different. The accounting is different. Everything's different, right? So it's very important to know the difference between the two. And then there's the business. Then there's the actual business model, the thesis of the fund, right? What are we buying? What are we funding? What is our business model? And in our world, it's mostly loans, right? Either originated, purchased, or whatever, right? They're loans. Short-term, long-term, however you choose to skin. Commercial, real, residential, mix of the 3, whatever you want to do there, that's your decision to make, right? There's real estate, right? There's hedge. There's all kinds of strategies you're doing in the business model. And that will dictate the structure of whether it's open or closed and those kind of things. So these are all things that you have to consider. And, the thing is that there's the right way to do certain funds, the wrong way to do certain funds, right? It's like, for example, if you're going to real estate fund, you're going to buy and sell real estate. I would tell you that I would not advocate for an open-ended fund if your model is going to be buying real estate, improving real estate, stabilizing real estate, and selling real estate. Why? Because the accounting is screwy because the value of the assets are increasing over time. So Bob Smith comes in on day 1 versus Joe Blow comes in on day 50. Their valuation is completely different, right? So I would much prefer a closed-ended fund in those type of strategies, meaning that the investors can't get out. They're locked in for 5 years, 3 years, 7 years, 10 years, whatever we send, right? That's important because you have to have really good accounting. So these are the things that are overlooked by a lot of what I would consider them. I call them real estate attorneys. They don't really understand securities regs. They don't understand accounting. They don't understand tax. And so they build these structures off sample that they picked up off the internet and just kind of give it to you. But I want to open a fund. They don't ask you whether should you do that? Is that wise? And if you look at a lot of the cautionary tales in the real estate world, many of them were real estate funds that had an open mandate, what I call kitchen sink strategy, and they were investing in buying and selling real estate. There's a very famous story out of Austin, Texas, where ended up being a pond, right? And It wasn't supposed to be that way. Like, he didn't listen, right?
Kevin, you also didn't mention Reg CF. Do you see a lot of like crowdfunding?
Oh, it's a good point. Yeah, Reg CF is actually really cool because you don't really need an attorney to Reg CF. So Reg CF is regulation crowdfunding. It's a regulation that allows you to raise $5 million every 12 months. No qualification of investors, no limitation on marketing. You're allowed to do it. You go through what's called a qualified crowdfunding platform or broker-dealer platform. 90% of the time, those platforms already have like a baked-in legal program. You just plug into it and do it. The challenge that I find in our sector in real estate is that it can't really do much with $5 million, right? It's very hard to be at scale. And if you're building a fund, you want to be at scale, right? So it's also like counterproductive to do series, do a CF once, twice, three times. Doing a lot of them is very counterproductive because you're basically trying to syndicate, and it becomes very challenging from an operations standpoint. So we don't do a lot of CF. I've done a handful in my career. Most of my clients are more interested in building something that's kind of like, the goal is to raise 20, 50, 100 million evergreen. Well, not necessarily evergreen, but the idea is like, the mission for us is a 5-year window to raise 25 million or 50 million or 100 million, whatever it is. And so CF doesn't really help.
But CF would be helpful if you're going to try to create a lifestyle business and keep your AUM low, right?
Well, I don't know if the problem with the lifestyle component is because you have to report through the platform a lot. There's a lot of paperwork that goes back and forth. So there's a little bit of admin a lot of admin that goes to the CF platforms. But I would say it's actually more work than a Reg D. But the entry level part is actually really easy. It's very cost effective. But I'm not a huge fan of programs that are geared toward crowdfunding because like the admin, right? Like the amount of work and time and energy you have to spend as a sponsor managing, let's say, 50 non-accredited investors, it's much more work, right? Like time. The amount of time that you have to physically spend to explain the strategy and explain the operation, explain what it is you're doing, and also answer their questions because it's a lot of money for them, right? That's the challenge.
And it's a lower amount, so you have a higher expense ratio if you still step keeping it.
And it's meaningful to them, right? So it's like a CF, you're raising $5 million, the guy comes in for $15,000. He's not accredited, it's a lot of money to them, right? So it's stressful for them. So they're going to ask a lot of questions.
Well, let's talk a little bit more about sophisticated investors then, because Reg D is probably what you draw up the most.
Oh, yeah.
And as Kevin mentioned, there's a B, 506B, which allows you to have 35 non-accredited investors or sophisticated investors in it, but you're prohibited from marketing. And that's what I set up to begin with, because when Matt and I finally decided to set up a fund, knowing that we didn't have the resource, the acumen to do it, which is why we brought Gerard in. We thought since we already had a whole captive audience of lender investors who did direct placement with us, we already had an established relationship with them, right? So we'll just migrate them over. But it made it very difficult because when they had a friend of a friend that wanted to refer to us, I didn't know how the hell they even talk with them. Like sending Kevin messages, and I'm like, am I allowed to talk to them? Am I not allowed to talk to them? Does this count as one touch point? Because you need...
Yeah, so the definition of pre-existing relationship is important under 506B, right? So the law requires you have a pre-existing relationship that's substantive with the investor. So the guidance the commission is given to build that is 3 touches without mention of the deal, right? 3 touches. It doesn't have to be an actual in-person conversation. It can be 3 touches. So it can be a form. It can be a Zoom call. It can be a phone call, right? In-person meeting, ideally. Like the 3 touches, and then you have a cooling off period. So 30 to 90 days is the cooling off period. Best practice is usually between 30 to 45.
This is an odd relationship.
Oh, right.
No, it never. I'm just telling you what the law is, right? I'm done it with the commission views, actually. Yeah.
And then you can hand off the offering and discuss the offering, right? And during those 3 touches, the objective is to get a feel for what their investment history, professional background, risk tolerance, and their sophistication in the asset class. And that's what you're trying to garner. So a lot of clients will send out forms with questions. They'll do a phone call with the kind of stuff. And frankly, it's one of those circumstantial facts that's hard to really kind of nail down on. So from an enforcement standpoint, the regulators aren't like so aggressive on it. They're really aggressive on the idea of marketing. Like, are you publicly telling the world on Facebook that you've got this and this offering? That will get into a bunch of hot water.
Kevin, you see this more than I do. I've always been curious when you talk about the, whether they're accredited, not accredited, on this situation with the touch points and the speed dating thing, it all work out the way it's supposed to.
It felt like you want to ask them on a date, but you have to go on 3 dates and you can't ask them if they want a date. I still, after that, I mean, I think we.
Because it's the issue of like if people they don't want to talk about their investment opportunity, but there's nothing saying you can't talk about business, right? It's like, what do you do? What do we do? Here's what we've been doing on the business side. Here's what kind of loans we do. Here's where we're based in. Here's where we and that kind of stuff.
So I was with that, right? There was like with all those rules and things in place. Do you mostly see problems arising not from a preactive nature? And I don't know what the answer to this is, so I'm asking. Preactive nature of SEC or state regulator. Somebody comes in and says, "Hey, this shouldn't be a client," or is it more reactive nature where it's like that client maybe didn't get the returns they wanted, they try to take it to court, and now it kind of pops up.
The only time this stuff pops up is that the SEC gets wind of some problem.
That's right. So it's reactive.
And it's reactive, right? So, but the funny part is that it's not always reactive for a clear reason. So like we had a case up where you guys are. The lender had one of the investors in the lender's fund was involved in that big Boeing scandal. There was an insider trading scandal at Boeing, and he was one of the executives there, and he invested in my client's fund. And so the SEC was investigating the investor. Well, that led to my client, right? And when the client started freaking out, right? So there was like no rational reason to get investigated, but we just like ended up getting investigated, right? But 99% of the time, it's going to be investors pissed off, rightfully so for some reason, calls the SEC or use
consumer protections on it.
Yeah, there's a hotline you can call it. And if you word it right enough, the commission is like automatically required to at least do some kind of investigation. And like I said earlier today, the way they investigate is like, all right, everything under the sun. Tell us about this, about everything. And then they'll inquire into how you communicate with your investors and how you acquire your investors and all that. To this day, though, and all the enforcement actions I've defended, and actually, like, I used to be in enforcement, I used to initiate the enforcement actions. We never really spent a lot of time on that component. The whole, like, the 3 touches thing. We spent a lot of time discussing marketing, like the advertising, because it's objectively easy to prove, right? As opposed to the circumstantial communications between the investors and are you friends, are you not friends? And it's kind of hard to prove that,
I think one of the things I would take away from all the structures you threw out there, right? Maybe a higher level thesis, and maybe not agrees with this either. I think you see all these things, and some of them based on your current Rolodex and people you want to bring in. You think about the framework of how you're going to start your fund. This was about starting your first fund. So you overly adjust to what you think today is the easiest route, not realizing that you need to think about, yes, you're starting your fund today, and yeah, you could easily get 25 of your family members in the fund to get you on going, but is that really the fund that you want to have in 5 years or in 10 years? So, I mean, for me, I like to have a longer roadmap than just what's applicable to me today, more or less. What do I want to live with for the life of this fund, this 10, 15-year life of this fund?
I had call last week. Client called me, yeah, I'm ready to go. My dad said he'll put in 100 grand.
Yep.
You're telling me, the funny part is the client is doing serious volume, right? He's doing about $30 million a month. I'm like, you're telling me you want to build a fund, the only investment commitment that you have is $100,000. Like, oh, I'm gonna put in $1 million. Okay, that's your money. It doesn't count. I was like, we need more than this. Your volume does not match with this. And so like we need a better plan. So I countered my interest. I told him, listen, man, go find yourself a handful of people that are going to seed you. And I would say at your volume, at least a commitment of 3. That's where we should get started. Because he's doing 30 million a month. You factor in the secondary market and all that. 3 million is where I want to see you as a starting point, and that's going to help you grow in the long term. But can you raise it is the next question, right? Can you out there and raise it? A lot of people overestimate their ability to raise.
Yeah, so we thought we had fish in a barrel, right? We started off with the 506B. We already had a captive audience of, trust deed investors around 40 million. So we thought this is going to be easy. But then how long did it take before I had to come back to you and like, Kevin, we need to change it to a C. Like, I'm getting people cold inquiries about it. I still don't know how the hell to talk to people. I can't market it. Just published a book too. So then I got inquiries there. Like, I feel strapped. I feel like really uncomfortable with governing this regulatory.
With stat data I'm going to, like in today's market, on our side of the house, 70% of files are going to be underwritten. You're going to be a C, as opposed to like it used to be 50-50. And then after the rule change, I would say probably 85% now.
And changing it costs a lot of money. And by that point, we've rolled in a few people in there and you have to do an amendment. You have to post it to a vote. It gets costly. And,
The And those folks are charged differently too. Right. I think is that still the case? You still can't charge carried interest on the unaccredited?
No, the nice part of carried interest on these funds is that they're not. It's not true carried interest because it's not. They're not gain.
It's just a performance.
It's just a performance. Yeah, and that's okay. Right? It's not gain income, so it's all interest income. It's gonna be okay. But the issue is really your cost of running that amendment, and then also dealing with the fact that oh, by the way, this pipeline of non-accredited that you had. Sorry, guys, I can't take it anymore. It's kind of the harsh reality of it.
Kevin, I've heard people say, which I disagree with, and you probably do too, but I said, okay, I'll set up a 506B for non-accredited and 506C for accredited.
That used to be okay, but the problem is that the commission, when they rewrote they amended the integration rules. Integration is this concept where if you're getting cute with our rules and you're abusing 506B, we're going to integrate all of them together and make them one giant thing because you violated our rules, and now and you lose your exemption. So when they amended the integration rules, they made it a little bit easier for you to do Bs in series. So they said, if you do a B, fill with 35, you can close it, wait 30 days, it used to be 90, and open another one, and you have a new 35 investor bucket, right? That was the change on the good side. The bad side was they were explicitly said the issuer must not simultaneously run a B in a C because they knew people were abusing it. And so from my perspective, even if they're two separate vehicles, if the mandate's identical and the same manager, right, I wouldn't do it. Right? You're just asking for it. Agreed. You're asking for it, right? The last thing you want to do is ask for it with the commission, right? They say, why?
Yeah. Why risk it? Well, and I've heard people say they have to be very distinct as well in the sense that this is what we do for private lending. Oh, and this separate, entirely different fund does oil and mineral rights.
I have a client that does, even in lending, he has a CRE bridge fund in his B, and he has a ground up construction residential loan fund over here in his C. That's totally fine. Different mandate, different return profile, different fees, everything's different. That's okay. Got it. Yeah.
So what kind of considerations does somebody need to take in choosing whether it's a B or a C?
The real question is, do you need non-accredited investors? Are they a must-have for your raise, right? And a lot of people tell me that they need them. I get it a lot.
I think it's easier, right? Because those
people and a lot indication talking them out of it.
Smaller checks.
Well, not just smaller checks. You're attracting people that have some money, right? And so they want to invest some money, but the problem is that some money is a lot of money for them. And they probably are not that sophisticated when it comes to funds and offerings. And so the challenging issue is as a sponsor, you have to babysit that investor. And there's a higher likelihood that investor is going to find a sympathetic a jury or judge. If they were to sue you, it's a lot more work.
Let's assume the math, right? If they can't put the 250 in, likely not accredited, right? So we know they're not accredited. So we know they don't have the 250, right? So you're looking at checks that are probably 25, 50, maybe 100 grand. Let's just break. So in the aggregate, maximum, you get all 35 and they'll put in 100 grand, which is a ton for an unaccredited investor. And probably you shouldn't be
well in that 20.
Right. So max, you're looking at, crazy out there. You're at $3.5 million. And we'll get into it later with expense ratios and everything else. That's really not enough anyway, I would argue, to have a fund. We can get into that later. So I struggle to find a reason to really do the B, in this structure and what we're doing.
The only other time where the B becomes an issue is I found this to be before the verification rules got a little bit loosened on the C side. The sponsor is very private. His investors are wealthy, but they're very private people. We actually have a sponsor here in the Valley. This is his reason. My guys are ballers. They play golf all the time, but they're old and they're cranky. They don't want to be bothered. They don't want to deal with verification. They will not invest with. They don't be bothered. They can't bother with this nonsense. That is actually a valid reason. You have access to all this capital, but it's country club capital, and these guys are just it's a real thing, guys. That's real. But that capital is hey, my dad was the same way. He's old school. He will never disclose this information if he can avoid it. And that's okay. I find that kind of approach is actually productive because, it's private, it's small, it's manageable. The ticket sizes are $100,000, $150,000, $200,000. And the sponsor typically does not need to market. He's got that country club, community that he can go back to, and he doesn't need to market. That's very rare today. In today's competitive landscape, it's very, very rare. Most of the sponsors out there don't have that ability to raise as well anymore, and so they need.
That's a much better use case for country plus capital than it is to just go after the small 50 7,500
Oh yeah.
amounts.
And that's a good reason. To me, like,
Yeah.
oh, I need non-accredited. To me, it's like, I get it. Practically, you tell yourself this, but like, I don't know that I love the idea. Because it's going to be painful for you. And I don't want you to be in pain. Like, I want you as the sponsor to be successful, so.
Well, let's switch over then a little bit about different types of capital that you can place in there, because we talked about sophisticated investors, and really on the side of like having, are they the ones that are really more typically the ones that are going to sound an alarm? But from a legal standpoint, sophisticated investors versus accredited or qualified purchasers?
So in the past 5 years, if I kind of like look at all the different investor disputes that I've been a part of, defended, like kind of half are the non-accredited investors who feel like they've been scammed because the sponsor explained things to them, but not in a way that they understood. And they didn't read a PPM. They didn't get a walkthrough. They don't feel like they don't feel like they knew what was going on. Another reason why investor dispute happens is because, oh, I didn't know that, right? But it's even exacerbated with the non-accredited, right? The other half are situations where the investor is going through something themselves, right? So like, it's because the investor is going through a messy divorce, is going through a big lawsuit, or is having major issues on his own portfolio, and he's angry, and he's looking for a target, and that happens to you.
And so what happens, like if your fund comes under fire, like it's reported to the SEC, or how about maybe a little bit about the local regulatory?
Yeah, usually what happens is you either get one of two things happen. It's first, you get an attorney letter, you get a demand letter. And it's actually a good thing. I would rather deal with an attorney than the government, because I can just settle and block them, get them out, right? So that's happens sometimes. And the other time, it's they go complain to the regulator. And they show you that they've complained to the regulator, right? And they contact the state regulator first, because they know that the state regulator is more likely to respond than the federal regulator is. So they'll contact, California DFPI and Washington DFI. Depending on the state, some are really aggro, some are like, go kick rocks.
Don't set up a fund under Washington State DFI.
DFI is probably the worst regulator in the country.
This is from a guy that's from California, you guys. Yeah.
On the security side, DFI is a million times worse than DFPI. DFPI, they're somewhat rational on the security side.
The Department of Financial Institutions, just so you know, for Washington. So every state has its own regulatory agency that governs financial transaction. Even in our state, it's DFI.
But to be clear, that's if you're dealing with securities, right? And in its general sense, well, these private debt funds, as we're talking about today, you're not really going to get a knock on the door from DFI unless there's something that you're violating per se.
I find that Texas is actually remarkably protective, and so they'll get involved, but they're also reasonable people, but they'll get involved. So they'll send an inquiry pretty quickly. I don't really like the Florida regulator because they do the same thing, but they're also like, they don't respond. And so there's that issue. Maryland can get remarkably aggressive. And then in the Midwest, Minnesota is probably...
And any sort of audit or lawsuit that can stifle your operations, right? Or can it halt it?
Yeah, so hopefully your fund documents are written in a way where like those kind of investigatory subpoenas or legal expenses are a cost to the fund. And that way you as a sponsor don't have to bear that. Now, if that's going to kill your returns in a meaningful way, you may want to spread out the pain a little bit, and you advance it because you're going to tip off your investors. You do have to disclose the fact that if it's a really material investigation, you should disclose it and report it. But like the cost, it usually amounts to nothing, but like the cost is like annoying because the whole idea of like the subpoena, that's everything under the sun, just the time and energy to respond to it, right? It's just so much.
Non-revenue generating activity. And again, PCW Danner, this is to say, hey, you should probably have a conversation with a securities attorney who actually operates nationwide too. This is why we went to Kevin, because they do top with state regulators in every state, and they know the subtle nuances of what you could come under fire for. And again, I mean, that could be subject, like we operate in Washington, but we do have investors in a multitude of states. So we need to know, what does that look like when we take on an investor from California? I could reach out to him and say, well, am I going to come under fire down there? Is this considered a security in California? So it's good to be able to have that conversation ahead of time, because the legal compliance or the legal defending yourself legally is a financial consideration on your fund. It's an expense. Here's a question over here.
How often do you see like investor relations people within the sponsorship? Is that recommended? Or just kind of thinking your thoughts on it.
When you start, it's going to be you.
Yeah,
right?
right.
It's going to
Should
be
be,
you.
yes.
It should be you. But but eventually, yeah. I mean, all the best and brightest funds have a very strong investor relations marketing game, and it's not just investor relations.
Do you put business development under there?
Exactly. Yeah. There's BD, there's marketing, there's investor relations. There's also like the best platforms where you use as a means to communicate with your investors and send reports out. So all that is part and parcel with success in the fund world. And the nice part is in today's world, like a lot of it has become commoditized. And so the platforms are really affordable now. Investor relations, it's one of the things that you will want to invest in once you start realizing, hey, we're cooking with gas now. We're actually raising real good money. And because that shouldn't be your focus. Your focus should be getting the capital in my door, but having to answer all the investor phone calls is very challenging.
Are there any questions from the audience on legal and compliance?
No, pues, these Reg D exceptions, do they also apply to fractional? Is no.
Yeah, so this is a question that I get a lot. These are securities exemptions, right? So it doesn't matter what kind of security you're offering; it covers all of them, right? So a fractionalized note is a security, so you can use it for that, right? So is an LLC interest, and so is a stock, and so is a bond. So you can use Reg D for any security, right? So.
We had Devon in our last session talk about how he was taking investors' capital as an investment in his business, 42 Solutions. He's a loan originator, so that he didn't have to place them on loans, and he worked.
Yeah, we did a note
with
the business.
Right. That 5 Reg.
And he wasn't planning on building anything too massive, so we did a very simple structure for him that didn't require a huge legal lift, and that was because he's okay with dealing with accredited investors only, and he was only doing it with this handful of people, so really easy to do that.
On the topic of legal and kind of setting this foundational framework for a fund, maybe give an idea of what the costs are.
My next question, anyways.
I mean, so I'll tell you, running a fund correctly is not cheap. So initial foundational costs, for legal to form the fund structure can range anywhere between, at our shop, on the low end, probably in the $30,000 mark. On the high end, $50,000, $60,000, $70,000. I have a client right now. He's building a very sophisticated Reg B structure. It's mortgage fund, mortgage REIT, offshore feeder fund, levered blocker, institutional JV relationship. It's a very complex strategy, $80,000, $100,000 strategy, right? So for most of the audience who's trying to build your first fund, probably on the low end. And if it's like what the fund's doing, even less than that, way less than that, right? Smaller scale, really boutique-y kind of thing. It's not a fund, right? It's a really simple structure. But that's kind of the beginning. Like I said, people, right? People and outsourced relationships and a lot of that costs money. I generally see the annual budget for most of my clients, with tax prep, audit, fund admin. They're probably just, looking to spend about anywhere between probably 20 to 50 grand a year, depending on who the vendors are. Because audit's expensive, right? And so it's a big thing. Fund admin can get kind of pricey. And then there's the employee costs, right? So the employee costs are typically covered by your management fees. So you got to figure out what to do there, right? Most of my clients have a relatively lean operations team on the fund, and they have a more robust operations team on the lending business because they can make more money on the fees on the origination fees, so they can pay them that way. So.
Well, let's break that down into two parts too, right? Because there's some setup costs. And I've had people challenge me because they'd asked me, how much we put down for our fund. And of course, I'd started up a B and then I had to switch it to a C. So that was a little bit more and a learning lesson. But people are like, oh, I got that done. And for $5,000 to $7,500.
Yeah.
What is your...
I mean, as an attorney, I'll tell you, it's tough out there for me because there's a lot of low-cost providers, right?
They're not doing it right.
They're not attorneys either. So I get this all the time. I'm going to this, I think it's called Black Card, and they'll go there and they'll build my fund for me, and I, a year later, I'm like, hey, you need to see the documents. I go look at it. It's it's written like a hedge fund. I'm like, this is the most retarded thing I've ever seen in my life. You're telling me that you have the runway to go do all these kind of securities investments, and you haven't been told that anything about investment advisor compliance. Can't get your attorney on the phone. He spent a lot less than he would with me, but he's not getting advisory work, right? For funds, it's 10% of it is documentation. 90% of it is advisory work. And I spend most of my time advising clients well after the fund is done. You can ask these guys. I don't bill them for my time once the fund is done, right? Because you need help. You need help.
I think they built since 2008. Why would you say that?
But you pay me, you pay me 30,000 on the pot. It's a big lift.
Now, yeah, I mean, I think this is a great point, though. So that
My performance rate dropped 5 basis points. Thank you, Gerard.
you can get an LLC and stand up your fund for 5 to 10 grand, but then what do you have to do after that? What are the recurring charges? What are the things you have to fix up? I don't have to do a damn thing. I just send an email to Kevin and he responds to me. And I can ask him about all the different things that come up because there are a ton. And it can get rather expensive if you have a billable hour.
Yeah, we're not a billable hour strategy practice, and so we're not billing you for thinking about your file, or not billing you for taking you out to lunch. I'm not doing that, right? And my philosophy has always been, if I can get you into flat fee, that covers my costs for a long time. But beyond that, it's also like there's complexities in when you're doing the project. If the counterparty is building it for you, their attorney or not, is basically just forcing it down your throat. That's kind of not fun, right? Like you have to figure out what's best for your strategy. So I'll spend a good amount of time with the client trying to figure out, all right, what's the model going to look like? What's the capital strategy going to look like? What's the operating company going to look like? We have to figure out what structure works better.
You ask us a lot of questions. Where we come to for anything.
And we're always reevaluating too, right? So roughly after year one, is it working? Are your investors objecting? Do we need to go in and tweak anything? Like, we're having to evaluate that because there's no one-size-fit-all model in any fund structure, right? I mean, no one fund is the same. I get nails on, it's off the shelf, right? No, it's not. So
there's legal setup costs, and then there's recurring costs and roles and responsibilities that you might want to outsource. And I think that a lot of people think that they can just handle it all in-house, or you got a bookkeeper. Bookkeeping for a fund is not the same as bookkeeping for your previous business. So Gerard, why don't you tell us a little bit about the various types of roles and responsibilities that you would want to see, whether it's in-house or outsourced, right?
Yeah, I think I'm going to answer, but then kind of moved from Ralph. Sure, I get there. Yeah, I look at funds as kind of if 3 core pieces to them, pillars that when you're assessing, should you have a fund, right? Do you want to have a fund? Regardless of the business you're in, whether a broker's business or you're syndicating, whatever you're doing right now, that question is like, should you move your current business like they did in their whole note business into a fund structure, right? To get to that point, I think there's 3 sets of things that you need to ask, and they're not sequential. They all interplay together and costs associated with them. Now, the first one is the foundation costs, right? I would start there. I know other things aren't always to control. I would start there. Or do the foundation costs, is that something that you can absorb? And are you willing to hire the right people to do it? And I mean, it's like hiring Kevin at what, 30,000? I'm not going to referral you for this, I promise, but that is worth its weight in gold. There is so many easy ways to do it for $5,000, and I would give you a reason not to do it for that reason. So it shouldn't be a checkbox on your foundational stuff, right? It shouldn't be, I can get legal done, check for $5,000. It's, can you do it the right way? $30,000. Okay, let's move forward. The next foundational piece. I've done some accounting before. I understand this business is not that hard. Interesting. Have you actually managed a fund before? You haven't? You need to hire a fund manager, your size, $150,000. Boom. Right? Then the next question, business development. I've got some friends and family, and I can raise a little bit of money here and that. Can you? And if the answer is yes, by the way, then you don't have to add these costs. The point is you got to go through kind of your foundation of, can you raise money? Can you hire the right legal team? And can you do even the underwriting work, right? Are you the right person to be the CIO, or do you need to bring in an analyst and things like that? That will then tell you kind of your foundational cost. That's the first part. Then I have, when you're running the fund, the ongoing costs, you have proactive and reactive costs. And a lot of people disagree with you, probably Kevin, on this one. I think the proactive costs in this world are markedly more important.
Well,
and proactive, to me, proactive ongoing costs is a fund administrator. And I preach this. Everyone has ever heard me speak this, or a couple of years before. Preach it more than anyone. Your fund administrator, which is a third-party fund accountant that is not your bookkeeper who does QuickBooks for your pizzeria. Okay, it's a very different person. Often comes from an auditing background of funds. Very different skill set, much more expensive. That's another one similar to the Kevin situation. I can get fund administrators all day for $10,000 or so. Sounds great. Horrible idea. Horrible idea. I just, it's terrible. The work that they do, you'll find yourself penny wise, pound foolish when you pool money together, there are complexities, especially if you have a fund that is it's open-ended. So you're taking money in, moving money out, marking assets to NAV, things like this. When your fund is building and you're pooling money in, it's not as simple as you think. The permutations are extensive of that accounting. And by the way, if you make a mistake, it is now you have to go back and look at how that permittal effect hit every investor and make restatements, etc. So the most proactive investment you can make from a cost standpoint, sounds weird, cost and investment, but best investment you can make on a proactive standpoint, have an incredibly strong fund administrator.
Helps raise money too. Investors love it.
Which 100%. And then obviously the third leg of that is the reactive one, which is an auditor, right? Go back and audit the financials. Auditors, I would argue, do two things, or primarily two things, where we think audited financials, they look at the work that you did, the administrator did, and make sure that the financials are reflective, copacetic to the agreements you're offering, your PPM, your offering documents. That's what their job is, number one. The other one is more about compliance, and this isn't about financials, more about if I get hit by a bus, can the fund operate, or would it be a going concern, right? Do we have a succession plan? Can I just take, on my own, can I go to US Bank, take $1 million out of our operating account and leave and no one will find me for 2 months, right? Or is there dual controls involved? So those are the things auditors check. I would argue the latter is markedly more important, again, because I think the other is reactive to what the administrator is doing proactively. With all of that being said, okay, so what does all that mean? All those come with costs, and you have to make sure that you can have an ability to raise capital, but also deploy that capital. It's also important, right? At a level that can make sense of those costs. So we're going to go really hyperbolic on this, like binary. Great, you can raise $1 million. Congratulations. Sounds great. Let's do that. And you can even afford the fixed costs. You're going to pay for it. You're going to put 30 grand to get Kevin on board. Okay. You got a good fund administrator on board, $35,000 a year. You return 10% on $1 million, 100 grand. What, you're going to charge 3.5% operational expense? Right? That's not going to make sense. And then you got your management fee, another 1% on top of that. And so I think understanding in your foundational costs that you're missing what that's going to cost you, your ongoing costs to manage it, and then eventually when we get to be audited, if it's not mandatory, but you'll want to get there at some point. If all of those things, you don't feel like you have a very strong runway and a quick runway to get enough assets under management to get there, then I would strongly discourage you from pursuing a fund. And one thing I didn't mention enough, and Matt, I'll quote you because you always call feeding the dragon. Once you created that fund, that is a dragon. You got to feed it, right? So what does that mean? Let's just go with another example. Most of you saying, oh, this would be an amazing problem to have. What if you have a great handful of country club investors, you got 30 million you can raise, and you do it. You got 30 million. Do you have the underwriting team that can fulfill $30 million of loans, feed that dragon for every single year in, year out, right? Do you have that? And if you don't,
just a single deployment too.
it's constantly
It's on. It never.
Well, that's where like the priorities have changed. A lot of clients are used to be like, they would do a little bit of fractional, a little bit of whole, jump right into a fund a long time ago. And now, at least in the kind of what I'll call fix and flip, construction loan, commercial real estate bridge loan, that industry, clients have actually shifted away, and they say, I'm going to do as much volume as I can first. However I get it done, right? And without a fund first, they'll table fund, they'll correspond, they'll do everything. They'll get the business ready first, and like the volume is really got to be there. Thankfully, I have yet to hear the past 3 years from a sponsor that said, we're under deployed. Like I haven't seen that issue just yet, but it's probably got color on the partnership.
I'm there.
Yeah, we're getting.
Bryce, you had a business, an origination business going and did private placement. Well, how many years did you do that before you started a fund?
Like 2.5. Yeah, but very similar vein. Like we did everything to make sure that we had the marketing engine, everything was churning before we moved over into the fund model. But like we talked about in the previous session, we had a number of cases where it really just boils down to autonomy for us. It was really that I had a deal go south, and it was because we had a direct placement co-lending model where investor would pledge funds, and then on the day of closing, they weren't there. And then it reflects poorly on my company. And I was like, I'm not going to do this anymore. And that was the day when we said, okay, I'm going to seriously think about switching over into.
That's the number one reason why clients switch over.
Absolutely. And it was the catalyst for us, because I was like I said, they bought their boat and they're having a great time, and I'm let high and dry, and it reflects poorly on our constant island somewhere. Yeah.
Kevin, I want to echo something you're talking about. I think you're saying that raising capital for a lot of people has been the issue lately, or I would say deploying capital has been not difficult. Right?
Yeah.
Is that fair to say?
Yeah, the volume is there.
And again, every market's a little bit different. In a lot of the markets I've dealt with on the public side, it could be different here. That often is later cycle mentality, right? Like let's go through that. Say, what does that mean? Like, sounds fancy. Let's actually go through what that means. When we'll stick with real estate in this example, but when things are building and ramping, right, you start to see success. Success, whether it's returns, whatnot, starts to attract investors. Investors bring in capital. So now you're raising capital, right? And deals continue to hit. Well, you've grown a capital base through the success that's now larger. Okay, fantastic. Now the problem is when the deal flow itself has deteriorated in quality, they're chasing those deals and funding bad deals because they have to feed the dragon. No longer filet, you're feeding it, dog food. Right.
Well,
that's what scares me a little bit.
And in commercial, they just got out of this mess, but in CRE bridge and construction, 5 years starting during COVID, right? That was the impetus when it started to become a problem. Multifamily for sure. Cap rates became an issue, but also just quality of product.
Yep.
The lenders were not getting the opportunities they needed, so they started chasing, and they started doing prep equity. They started doing mezz. They started doing basically dog shit in their portfolios, and then default rates started declining. And now 5 years later, they're unwinding their.
And I will use that to say, let's take a little bit step further. Let's say you have a fund, right? Let's say we're there based on if you already do, or in 5 years from now, 3 years from now, you do have it. This brings up an opportunity for you, I would argue, and one that you shouldn't shy away from. We did this recently. We're in the Pacific Northwest. We have our own perspective of markets up there and where they're at. And I'm not going to use the word completely pessimistic. There's some levels of concern in that market, right? Last time we're going to hit the gas right now. Yeah. Okay, so that's an opportunity to open up to your investors. Don't feed the dragon dog food. Tell your investors in your letters, whatever correspondence you need, be proactive. Say, guys, and they actually like that. In my perspective, they like lesser returns if they know it's copacetic to lesser risk and you're being proactive and not chasing incentive fee or carry back. And so for us, we recently saw this. We've seen for over 2 quarters, we've done this now, back-to-back quarters, reiterating, hey guys, we're gonna have a little bit more cash drag, right? Just another way to say, if we have $50 million in assets, I'm not gonna have $50 million deployed. I might have $10 million on the sidelines. That's not usually the case. That $10 million is not earning 12 or 13%. It's sitting back. We're de-risking the portfolio because we're not seeing deal flow that we like. Investors are getting lesser returns than they expected. They're still positive, highly positive, still within our range, but on the lower bound. And I can't tell you how many thank yous I got from people. Thank you. Thank you. They didn't mind the lower returns. They wanted the proactive nature, be transparent, and do the right thing for the portfolio and their money. Don't chase returns. Don't feed the dragon dog shit.
Yeah. And also the inbound too, right? So like a lot of sponsors, it's a good problem to have, but they are raising money and they're finding good success and they're realizing, wait a minute, I don't think I should take on this investor, right? And like the smart sponsors are the ones that are like intentional about adding new capital, especially big tickets to their fund, because they're going to be forced to start chasing and the quality of their loans start decreasing, or they pivot to a more balance sheet heavy model and they're going to hold their loans longer. So like, you have to be very intentional about how you're going to manage that portfolio, because if you end up like the CRE guys did, then you'll not be around in 4 years.
Yeah. Kevin, would you discuss, like, I don't know the right word, if the model is the right word, but like, for example, I hear a lot of people who are like, we do, there's different classes. There's a 9% class, or 10% class, or this one has a 80-20 split or a waterfall, or like sometimes people will, yeah, or they'll say like, are the points, the origination points included, or is that outside? If you cover that
waterfall. So let's talk about fees first, right? So this is like a standard kickoff call discussion I have with a client. Fees are an interesting topic, right? So investors are fee sensitive, right? So they don't want to be overcharged on management fees. I think investors have wisened up to like the idea of like servicing fee and asset management fee. In lending, they're kind of one and the same, right? Origination fees are a topic of debate. Clients that that's why I asked them, like, how do you plan on raising the money? Like, what's your background? I want to find out, because if I know the client's going to be going and hitting up the investment advisor community, the wealth manager community, the quasi-institutional investor community,
They're not dumb.
then I would advise them, it's probably wise to either share the points or throw them all into the fund, because those types of investors or representatives are going to say that's a conflict of interest, and they're very sensitive to that issue. If you're going to be telling me you go after high net worth investors and small families, and then they're not going to care, right? So they want you to have the points, because the argument from their perspective, the advisor community's perspective, is you can put dog shit into the fund and still earn a lot of money, and I'm going to suffer. That's their logic, right? It's very zero. It's very zero sum game and energy, but whatever. So that's one of the big issues. On structure, there's a whole number of different structures, right? So you can have your standard 2 and 20 model with like an 8% pref. That's a very common model, with an asset management fee. Very popular to this day. Classes, there's all kinds of class structures. Most common is based on dollar amount, right? So like, you invest $1 million or more, I'll give you this structure, or if you under $1 million in that structure. And usually the bigger ticket, the $1 million or more class is a little more accretive, right? The higher return, or lower fee, or better liquidity, or whatever, right? So there's that. There's founder class shares. We do that in funds all the time. So these funds are usually open-ended in lending. The founder class will be the benefit of the seed investors or the anchor investors, and we're going to give you a preferential treatment, right? So we're going to give you enhanced liquidity or no fees or whatever. There's usually some kind of segregation and discrimination between the two different classes. As it pertains to kind of waterfall structures, the consistent thing that I advise clients against, unlike in real estate strategies where you're based on gains, right? You're based on growth. This is income, right? So like the idea of returning capital as part of the waterfall doesn't make any sense. And I see that a lot from other attorneys because they're real estate guys, right? And so that doesn't make any sense here. We want to hold that capital. We want to redeploy that capital and make more loans, right? So, that's the one thing I just don't do. Everything else is up to the client. But, the small clients, they really like that fixed return model, that 8%, 9%, 10% structure. It's simple. It's simple. It's like a note. At net of 10, you get 10. We're nice and easy. I'll tell you that works up to about 100 million. Like, I haven't seen a fund get past 100 million with that kind of structure.
It's a tough sell. It was hard to 7 to 8% fixed to a high net worth individual.
And you're making 12.
Probably not a 506B.
Especially if you're levered and selling paper, like then you're like the sponsor's making 12 and the investor's making 7. So there's that issue. But those models can be adjusted to be really, really attractive. Like I have a client out of Baltimore. They have a structure where it's a 10% fixed return. The sponsor gets the net of the 10, but
Don't guarantee though, right?
Well, that's the thing, right? The way they did it was the family it's a family office that runs the fund. They have a $25 million allocation into the fund as seed money. And that $25 million is actually the first loss, risk money, right? So they're going to absorb the first loss up to $10 million. And so that's like, oh, shit, hell yeah, right? Basically insurance.
So it's a PPM.
They got rid of it. They got rid of it recently.
I wonder why.
Yeah, they got rid of it. He raised so much money because of that.
Or all the losses of this $5 billion family office bill.
Actually, if you think about this, first loss protection is actually kind of more of a marketing ploy than it really is a risk to the sponsor. Because like, if you're making good loans, let's say for example, 65 LTV in a first position on a bridge loan in a good neighborhood, like the risk of actual principal loss is pretty much next to none. So like it's like it's just an optical, right? The only other thing that we see is kind of a commonly debated issue is leverage, right? Like nowadays, I would say 99% of the time, the client wants the ability to take leverage. But then investors tell me like, I don't like leverage. I'm like, no, you should like leverage. Like, there's no reason not to like leverage.
Debate that for a little.
Oh, I could debate that.
Let's do it.
Yeah, I would debate that. I mean, it depends, right, on the cost of capital.
Oh yeah.
And that's what the big thing is. And I go back to
Give a brief explanation too. You mean levering a fund? What does that really mean?
do you want me to?
You go enough. I got you. Yeah.
So let's talk about it in a simple sense. If a fund has $100 million of investors' capital comes on day one, and I got $95 of that I allocated to loans, and maybe $5 of it sitting cash in bank to do something else. That's 100 for 100, right? Funds can be structured where that fund can go to the bank, go to a bank, another lender of some sort, right? And go various types of opportunities there are. hedge funds, by the way, just go to your brokerage account. In fact, most of you have the same access. Probably if you have a brokerage account at Fidelity, Schwab, JP Morgan, you get, and you can get a it's a $100 fund, right? Very small, $30 loan, right? And they can go make $30 of additional investments and other loans. Okay,
so you have betting my money.
If I'm leveraging. You guys give it some rope. I know he's on a couple derivative. No. So in this case, if I think of my balance sheet, right, I have $130 in loans because I made an extra $30. $100 of that was investors' capital, and I have a $30 liability I owe to the bank, right? Because I use that money. Investors, you get your returns are amplified, assuming shit doesn't go wrong. That's the big assumption. Your returns are amplified because you have more assets than you put in returning more money. Problem with that is that extra incremental amount you borrow from the bank is not free. The bank wants to make money on that. And this is where I think it really comes down to the cost of capital relative to the return and the safety of the return. We're going to take the $100 you put in and the $100 of asset or loans, throw that out for a second. Let's just talk about the incremental decision to lever up, to take on a liability in order to invest in other assets and amplify returns. Let's just look at that incremental piece. Obviously, let's go with the simple example. If the bank is going to charge me 7% for that money, okay, as the fund, and that money is going to be deployed into loans at 6%, you would never do that. It makes no sense to be paying the bank more money, right, than I would get in return. So, but there's a break even. I would say 7, you would do it, you're neutral. Would you do it at 10? If the asset you're getting return is at 10, right, and then it levers at 7, would you do it? Well, what if your default rate's at 5%? There's questions here. And this, by the way, this is the job of the fund manager, to be clear, is to determine your risk team, depending on the size of the fund, to determine what's appropriate and when. Where I have public markets, and I'll get to privates in a minute, where I have a distinct, in public markets, the leverage is, depending on your size, is incredibly cheap and no one gets it cheaper. Okay? What do I mean by that? If I have $1 billion of assets running a public securities hedge fund, buying and selling Apple, Google, Microsoft, all this good shit, right? Got $1 billion at Goldman Sachs. That's where it's custodied at. Goldman Sachs sees that, no problem. Gee, I'm going to give you $500 million on top of that. And you can now invest $1.5 billion. That money, that $500 million they give me, is incredibly cheap. It's at the lowest rate, generally plus a little bit, like 25 basis points. Like Fed funds rate plus a little. Why? Because the collateral is perfect. The bank sees their collateral daily. It's marked daily. It's public securities. So the money they're lending at your $1 billion of Apple's computer stock and Google and all this shit, they see it every day. They're going to give you the lowest rate. There's no risk for them. Really, there's almost no risk for them. So there is super low return for the fund. Now, where it depends on the private side of things is depending on the lender. That is not, it's someone who's lending money against a $100 million portfolio of loans that are, hard money or private money loans. That's not the same collateral as Google stock and Microsoft stock that they're seeing daily. That rate is going to be higher, right? And so that's where it creates a little bit of a problem. And add a third element to all this and merge both of them now. Okay. So with that being said, here's where I've always laughed at this. And because that line is more expensive than typical, like these private lines, right? Let's say it's at 7%. Let's just go with that example. And that's not what, let's say it's at 7% to get that extra leverage. If I'm an investor and I have a brokerage, I'm accredited, I got $1 million brokerage account, I would much rather have you not be levered. I'll take out a $200,000 loan on my, if I want truly a levered return on your portfolio, run your portfolio with no leverage. I'll put in 200 grand more than I thought I would, keep my brokerage account going, borrow against my cow line at 5%, which is better than what you're getting at 7% by taking fees and passing on to investors. So I think that there's like some rate arbitrage, if you will, between private and public markets. And that is only going to get worse, by the way. That arbitrage is only going to get more accretive to the individual investor as the Fed funds continue to get lower, because that's what your personal cow credit access line, PAL lines are based on. And so I continue to have an issue with using leverage to enhance returns under many conditions. Not all, everything is different. Under many conditions, like a fund our size, I have a big problem.
Oh yeah, it's not a yield enhancement tool.
No, yield enhancement. And where I do love it, and the last piece I'll mention is I'll rant all day on leverage. Where I do love it is using it to manage cash flow. Okay, let me explain that because that's completely different. That's a tool. It's not to enhance returns. Let me give you an example of that. We're a $50 million fund, let's say, and that's it. $50 million fund. Actually, let's go 45. $45 million fund. I've got $43 million of loans out there. And I've got an investor coming in who's going to put in $5 more million, get me to, or $2 more million. So it's going to take my AUM from 45 to 47 million. And I know that money's coming in. But we have a loan tape that wants to fund 6 million, right? So I may need a little bit of a short-term loan just to match the investor flow with the timing of the closing of the loan and vice versa. Another place where that, well, we've seen this in our fund happen is if what you don't want to do is take in a bunch of money of AUM that's not going to be in your fund for 5 years because you've wanted it just to fill a loan tape that was robust for 6 months, right? Oh, great, I filled this really robust loan tape for 6 months. I did that by raising 10 million. Well, guess what? Your fund went from 40 to 50 million. Now that loan tape is no longer robust, I got to feed that dragon an extra 10 million. And so in order to kind of manage
they used to that above the outgoing, right? Because the outgoing investor requests also manage.
Exactly. So I would use leverage as a tool if you can get it.
Operating line
to operate. I would not use it to enhance returns as a willingness.
That's the thing that one of the myths out there from investors' perspective is they believe that the way I simplify this is they watch the margin call one too many times. You think that these lines of credit are these big scary things that they're not. Like in private lending, there's only one facility out there that's mark to market. Mark to market is kind of scary because the bank, the lender can mark the assets to whatever value that the market tells them they are. Not as scary if you really distill it down because they're book value, right? But most of these people are banks. They're not doing really aggressive, like 3x the value of the portfolio. They're doing 65% of the loan amount at most, right? And so like you're not super levered. Most of the funds out there are probably 30%, 40%. The aggressive guys are like 60% of the portfolio. And like, yeah,
There's a lot of hard money lenders that are out there like that. Because just like get the end of year reports from other funds they invested in, and they got like, $40 million fund and a $27 million line. And they're drawn against it at about 70%.
Right. Which is, but if you think about it, though, what's the portfolio look like is another question, right? Because if you're in heavy construction or rehab, funding draws can be very time sensitive, all right? And so having a lot of credit to fill that gap is going to be massively important. But from an investor's perspective, the fear is like, oh, the line can get called, and then we're all screwed, and the bank's going to take all the loans. Like, I have never seen that happen ever. Like since 08, I have never seen it happen. Like there's one fund that the line got called because of the defaults got so bad and they were unable to liquidate in a timely fashion. But it wasn't what we're doing in our usual clients. They were doing $100 million construction loans on multifamily across the country. They had massive exposure and they had a lot of leverage. Your average hard money fund, they're not exposed to any of that level of degree. And the banks that they work with all have a reputation of like, I don't like that loan because it's in default, get it off the line. Get it, and then if there's default creeping, we're going to phone call and we're going to say, all right, what do we have to do here? We'll move things around. The bank is very unlikely to call the line because it makes their life so much harder and they don't want to lose the customer. So like, it's going to be a lot more work with the borrower kind of relationship as opposed to like, bring the hammer down.
And again, as prospective fund managers, or you want to start your own fund, I think my rule of thumb with this, every asset is different. By the way, going back to public markets, I've seen funds that we were in that were 15, sometimes 20 to 1 levered.
Oh, yeah.
And that's okay, believe it or not. It sounds crazy, where you have $5 in assets and you got $100 of it, or $5 of actual like core assets, you have $95 in liabilities. That seems insane. Depending on the risk you're taking, carry trades, currency trades, that's actually not abnormal and it's relatively low risk. In this situation, leverage, I think, needs to be looked at continuously. If you can get an access line, like a line of credit as a fund manager, that's great. Use it to manage cash flow, not to enhance your yield most of the time. There may be some times that you've seen where it makes sense. I have yet to be convinced. I've never seen it. Shouldn't be in this space. It's not a yield generator.
Other ways to generate.
Yeah. And so get it for cash management. Don't get it to be bettering your comp in good time.
I would prefer the client sell their paper to generate yield than to use leverage to
100%.
because then that gives you liquidity and the yield spreads are there and your loans are typically not going to be bought back. And
Well, let's talk about that real quick then, because we were talking about that as we were building up the assets under management, the AUM on our fund. And we were talking about recapitalizing because we didn't have new investor capital coming in, or a lot of them were still sitting in whole trust deeds, and we were waiting for that paper to term and then roll their funds over. And we came to you and said, can we sell through some of our notes? But we can't sell them to just any high net worth individual, because why?
well, you can, but you're not going to get the economics, right? So
What if you just deem it as security though?
yeah, you can't. Oh, for the fund itself.
Yeah.
Yeah. So
The fund is selling their loans to create a spread. They cash a lot.
the fund is selling paper off its books to a high net worth investor, your average trustee investor, your average note investor. That's a security sale.
Yeah.
A whole loan transaction once in a while with all the right reps and warranties, I think you probably could pass muster as an actual loan, an asset sale, but I wouldn't do it in general. The fractionalization outside of the fund has gotten many funds in trouble. And what happens is it's not like it's a security sales. Therefore, the fund manager is now deemed to be an investment advisor. So all the extra compliance kicks in, and it's not the end of the world, but it's not something that most lenders want to deal with.
No, it was a huge complication, a total downer. Hear that, because we thought, just like Bryce, were like, this is going to simplify my operations, right? And I'll create a small fund, 5 to 10 million. I'll use it essentially like an operating line, right? Because then I'll have won't have these cash management issues I have with private placing whole trustee capital. And then when they get their funds back, then we can sell it off to them. And
So what
I was eager to hear we can do.
There's a way to do it, right? There's a way to do it. The way the commercial lenders do it is the right way to do it, right? So what they don't sell them fractional. What they'll typically do is they'll take a loan and they'll go to other lenders. They're not going to investors, they're going to lenders, right? And they say, hey, let's syndicate this transaction. And they're going to do it via a participation agreement. And it's going to be a fulsome reps and warranty, institutional grade transaction, which will not be considered a security sale. And that's the way you do it. If you do it with, your mom and pop TD investors, it's a little bit trickier, right? And then you run that risk. Now, selling paper in today's market, it's different. And, I know it's a note investor conference, and I'll tell you guys, it's a interesting time because, at least in what the markets that I concentrate in, there's a huge secondary market now. So if you're thinking about a fund, I have many clients that they don't need a lot of capital anymore because they build a fund that's manageable for them, small line of credit. They originate a lot more, and they sell that loan product to the secondary market, right? And they earn a spread on that sale, right? And so it's a very lucrative and very accretive business model because they don't have the drag as they used to, and they can sell construction loans, fix and flip loans, multifamily loans to these Wall Street buyers and earn a spread on them. And so that has changed the dynamic from 10 years ago. The problem is now that your loans need to conform to those boxes as opposed to your box. That's the give and take with.
That's what we run into a little bit, right? Like we do a little bit more exotic things, a lot of process seconds, and so those things are.
Well, and we don't get full-blown appraisals, or we do in-house evaluations. Kind of prohibits us from being able to.
Well, I'll tell you right now, the nice part is the appraisal side is loosening, right? So many of these firms are starting to loosen up on the appraisal side. They're not letting go on FICO and borrower experience, but it is. I always tell people it's an opportunity to look, because if you can kind of force the loan into that kind of framework and find a buyer that's helpful to you, it's just an added way to get more loans done and increase the revenues to both the investors and to you, the sponsor, because that yield stacks. And so it's a much better yield enhancement tool to me than leverage is.
So to that point, what quantifies it as security sale versus asset sale?
I mean, it's circumstantial, right? So let's just say, for example, they got a loan they want to sell to someone, and I'm the buyer, right? And it's me, Kevin Kim. I got a day job. I'm not a lender. I'm relying on them to do all the work, to do the underwriting, to negotiate with the borrower. And I'm approaching this transaction as an investor, right? Truly an investment for me. I'm looking for the return. That's security. No matter what you do, it's security. Change the fact pattern. I am now 2RAC Capital Partners. I'm owned by KKR, right? I have $1 billion balance sheet. I'm going to enter into a master loan purchase agreement with them that has a very robust set of representations and warranties, including one that has credit underwriting guidelines, purchase guidelines, buyback provisions, super well thought out transaction. The regulator cannot say it's a security sale, and they won't say it because the government is the biggest buyer of loans in the country, right? So, and when you sell loans to Fannie and Freddie, it's the same kind of agreement. You enter into a master loan purchase agreement with Fannie, you sell loans on a forward flow basis with them, right? So that's the challenging issue is, and I've had some clients where like the buyer is kind of like a wobbler, right? He's got a lending business. He's an actual lender. And he's got a portfolio of loans, and he's got employees, and he's got a license and all that fun stuff. I can structure that transaction for you. I think that makes sense. But if it's someone like me who's got a day job, like I guess it's a security. It has to be. I'm looking at it from an investor. What is the investor expecting? And that's really what drives it.
Well, and then let's just dispel the myth of like, oh, then I'll just go to an institutional buyer.
Hard.
Torok is a capital markets provider owned by KKR, huge.
Yeah.
We operate anywhere from 35 to 60 million in originations annually. We're small. They won't talk to us. We can't capture an audience, nor not that I want to, but they would not recognize us.
There's that issue too, but there's also like the structure and how you're transacting. Because if the loans are on your balance sheet, you can't sell them. You have to own the loans. So like there are smaller organizations that will work with smaller lenders, but there is a market for it. But you have to be actively involved. Yeah, some of them are gone, right? Some of them are gone, and that's a product that cost Pear Street's gone, yeah, a long time ago. But like, the market's gotten a lot better in that respect, and I think that there's an opportunity there. And even for the lenders that are smaller, to your point, like build the business first, right? Like, there's so many interesting correspondence and broker programs now, that like wholesale programs now, like you can get your deals done that way too. So, I don't poo-poo on that because like at the end of the day, your job is to do loans. And if you have to conform to someone's box, our friends in conventional, our friends in commercial, our friends in non-conventional, they all do it. So why don't we,
Bryce, I mean, because you and I are more like, your average everyday people. We came from tech background, right? We're relationship-based lenders. We obviously aren't necessarily in the same class as Kevin and Gerard. But I mean, and funds have done well for us. But like, what's one thing that converting over into a fund has served you well, and what's one thing that is just now going to be a hard no for you in running a fund?
I mean, the biggest thing is securities fraud. I mean, most private lenders, to my understanding, are doing it illegally. Like, unless you have a singular investor on a singular note, when you carve it up and you start doing fractionalized notes, it's a security, and you legally can't do that. So I would say that's honestly number one, is knowing that I am compliant. And that was really the kind of the impetus to move into the fund, is just to make sure, there were other circumstances and things like that. But really it was like
Vehicle to carry out your day-to-day business.
Absolutely. It was like,
What's more easily
significant.
Correctly.
Yes. Yeah. And that was it. It was like, I want to make sure that I'm doing everything above board, because if everything goes belly up, I want to make sure that we're compliant. We're doing everything the way that it should be. Yeah.
What's one thing that you know now that you wish you had when you started your fund?
Oh man, good question. I would say honestly, it's not as intimidating as it originally sounded. People were talking about the B's and the C's and whether I should do a Reg A and then the blue sky laws and like filing this. And I was like, I mean, for the most part, it's really not that bad.
get a Kevin.
Like, yeah, obviously have someone who
And blue sky is so much easier now today than it used to be, because that used to do all.
Right. You just go to the website and you say, okay, I have Pennsylvania and Idaho.
Right.
And like, you check it, and then it says you owe $600. I say, cool, pay. Like, it's really not that difficult.
All the solutions that were once upstream have all come downstream, and they commoditize, and they make the manager's job so much easier. The quality of vendors have now just so much better today. So
the funds, maybe we should see if there's any questions to stop there that we've been going for a while.
As a one comment, go off of Bryce, and I hear it so often more. People are saying, yeah, I'm doing loans, and I have my friend here and my friend here, we combine them together, we did these loans. A lot of it comes from lack of knowledge, lack of education, not participating and doing the homework. So it's not uncommon. I hear it all the time. Can I add my two buddies together? All the time I get the same bitch stats.
It's not a security. You get that else?
Well, but I think too, in this day and age, everything is, thrown out there is like, oh, it's easy. You can do this thing and generate passive income. Okay, maybe that's partially true, but like, like if you play with fire and you don't know what you're doing, you're going to get burned. So make sure that you understand what you're doing.
YouTube managers are not liable for your securities fraud, okay? But they do get credit every time you click and save their video. Hey, you got a question?
I'm curious. This goes back to you were talking about feeding the dragon to the crap deals, trying to get that. I was wondering, where do you guys see that being driven more from? The fund manager who got an ego, or not you, or the
I could have an ego. I was there.
or the people that are actually in the fund demanding the
No, not that. It's the fund manager. It's the fund manager, and we've talked about this before, but
Or the originator, because Matt's the one that stresses out more about our cash drag than Gerard and I. Yeah.
So here's an interesting dynamic I have seen too many times, both in fraud and both in this, and they're not directly attached. Give me some rope on this. We talked about fraud the other day. Fraud doesn't usually start because somebody is like, I want to create a Ponzi scheme. It's because they're trying to keep up with something, an expectation, personally, financially, whatever that is. And so it leads to a set of bad decisions that are short-term thinking, right, that lead to this and it cascades. Now, where does that have some overlap to what your question was? Fund managers, sometimes, not all, it depends on their situation. It's not that they want to take these bad deals. Sometimes it's almost the fear of, if I don't take it, right? It's almost like you're letting down your investors. Okay, it's an irrational fear they have. Goes back to what I said before. Easiest way to do that is be proactive and let them know, right? Be okay with. It's like the guy who wants to turn a Ponzi scheme to keep his returns up. Be okay with having bad returns and don't do a Ponzi scheme. On this side, it's be okay taking chips off the table when it's appropriate, stewarding a 20-year investment relationship that way, versus always trying to keep up with what you think their expectations are. You'll often find out they're counter to what you think they are. And I see that that heuristic incorrectly driving bad decisions to feed the dragon at irrational times. I'm not going to throw any of them under the bus by name. Won't do that. Not appropriate. But we talked about this recently. We sit in our investor meeting, our managing partner meetings, 4 of us, partners that are firm and fund, et cetera, both entities. And we always talk about markets broadly and is where we think risk should be from that standpoint. More qualitative, right? I'll do the quantitative work after that and come up with a number, but qualitative assessment. And we continue to have this pessimistic conversations. I couldn't believe when you sent me stuff. I'm just thinking, why would everyone else think like this? You were sending me things, again, other people in our region, so they're fishing in a similar pond. It's not like they have some asset class that, is amazing and different, right? They're increasing their loan to values, so 85, 90% from 70, so taking on more risk right now. And to stay competitive, are lowering their rates from 12% to 11, 10, and 9. I'm like, what the So those are the ones that I'm concerned.
Trying to compete in the market, right?
Volume. Whereas we decided, Matt being involved in investor relations, we have our corporate counsel, he's a business investor with us, silent. Gerard manages our fund, and I'm the CIO. And we sat down at dinner before the end of the year and said, what do we forecast for 2025? I mean, we can go up to 50 AUM without having to call Kevin up for an amendment, right? So we're like, should we? We're sitting at low to mid 30s. But what do we want to mark as our target for origination? Because bear in mind, whatever we're going to raise in capital, we're going to have to match that probably 1.5x, maybe 1.25, 1.5 times an origination, because our general term is 8 to 10 months. Most of our loans term and pay off about 8.5 months. So we said, do we really want to increase our loan origination? If we really fill this up, the whole bucket to 50 million, how much do we have to originate? 60, 65, probably on the aggressive side. Do I have that in me in this market? Can we do that just in Washington State? Do we want to enter other markets? We actively made a decision to cap it at 40 million. So we would only raise the AUM on ours to less than 20%, right? I don't have a part of both numbers, but something like that, right? Until this guy keeps golfing with all of them and raising capital and bringing it in. And now all of a sudden we're at 45. But I mean, the decision was made early on, hey, we don't want to increase and have a larger cash drag if we can avoid it. And it's true, right? But at least we're having conversations with our investors saying look, we do have about 12% cash drag right now. It's sitting in a high yield money market account. So it's earning 4.75. We're not allowed to invest in securities because all of a sudden then we have to bring in an investment advisor, and we don't want to do that. We want to stay exempt.
I can't take that cash and go buy high grade corporate bonds yielding 6% with it, right? There's always so many extras.
You're invested and only keep it into a high yield money market account. And then we say, bring on Gerard because he's our fund manager. He says, and this is how it might affect our future quarter returns, by 25 bips or 15 bips. So they know we're still going to give them, we're still projecting to give them double digit returns, no guarantee. And we'd always been harping it, above 10.5. But we wanted to set the stage that you might want to expect that it's going to be a little bit lower, but there's a conservatism being played here on purpose.
We haven't on that more anecdotal. We haven't had it on this run doing in previous funds I've been at. Similar situation, different asset class where it's like equity valuations are too high, so we're pulling back. But similar conversation, and I actually love the other side of that is that we had people leave the fund because of that. I'm like, thank God, because that's the last person I want. It just shakes out the dipshits.
The best ones actually they call their investors and tell them, hey guys,
there's a quote for you. Shakes out the dipshits.
We're going to choose. Like the best sponsors will tell their investors, we're going to choose right now, right? Whatever choice they make. And they're going to tell their investors, all right, the market is bearing this. We're going to make a choice. And they have the right to do that. And whatever choice they make, there's going to be a reaction. And they always tell, if you don't like it, guys, we're happy to redeem you. That's the right kind of mentality you want to have, because that goes to
we kind of thought we might have a few redemption requests, and they all were like, yeah, sorry, so we like it in that.
They can't both be this good. It comes to you, if you as the investor, the sponsor comes to you as a disciplined operator, you're going to like it more, right? So it's counterproductive for the client. But that's the challenge. The consistency is hard to maintain in a very dynamic lending landscape.
For sure. So that's the follow-up. So if your competitors in the same Washington State market, Seattle area, whatever, are eating your tail, like how much longer they could be able to keep that up before they're your clients?
That was the best thing. Look at 2020 when COVID hit. All their lines were frozen. Hard money lenders couldn't recapitalize. Guess who was still funding? Oh, the little engine that could. Little old, Flame Family Lending wasn't worth much. A lot of other hard money lenders kind of like looked down on us because we were tiny and a mom and pop, but we kept drilling it out. And boy, during COVID, our reputation skyrocketed just because there was no competition. And they realized, investors did, that when they were investing in operations like that, they were highly volatile, that might be levered and had their lines frozen. They just couldn't access them, and the cost of capital is too expensive now for them. We didn't have those kind of institutional constraints. So we improved, and the same thing in 2022, right?
And then to be clear, the benefit is that you've been around the business for a long time. You have a big brand name. And so there's also trust in that you've done this after a couple of times of being right. Then they don't even question, hopefully, by the third or fourth time. That's the way to shake out.
Well, we've lost a lot of deals, though, for lower interest rates with other bigger players. And then they realized that even if I can get it at 10.5 and you're charging me 12, they might not be able to do 10.5. And they left me stranded at the signing table, at the funding table during COVID when I had this massively great deal and a non-refundable earnest money. I'll go with Flynn all day, every day, because that 1.5 differential on a 6-month bridge loan means nothing if you can't close. So they'll use this all day, every day now. I haven't had to change anything.
I'm going to use this investor. Is there any other questions, actually, then I'm going to?
I have a question.
Yeah.
A little different on this topic. The art fund buys a Disney paper. We don't originate. And so if we want to go into a lever some of our funds, does that create any sort of EBIT tax to my investors?
So there's a solution for that. Right, a REIT could probably, UPI will be a product of any arbitrage derived from leverage for your non-taxable plan investor, 401k, IRA, all of it, right? So, and that's, it is what it is. You can't stop that. So there's two solutions that are commonly used, A, a mortgage REIT, B, a blocker, right? So you use a corporate blocker, typically move overseas, and that will be done with more pension funds, real pension fund, to eliminate the UBTI tax issue. Now, when you're buying this paper and you're levering it, is there an arbitrage to produce UBTI? Because UBTI is only taxable after the first $1,000. So it depends on how much UBTI you taxable. So it's a very sensitive issue for the non-taxables.
Yeah. We probably won't get into that, but it's just something we found out. You need it. But just like the example you had earlier, there's a $5 million tape, and we got $4 million. So I might have come up with the difference. So,
yeah, I mean, to manage the cash flows, right? It's an important thing.
So I was gonna say we're talking about actually joking about shaking some bad hands out on the investor side because old capital is not the same. You gotta remember, one of the things that I think I want to get in front of, I don't know if it's too off topic. No, it's on topic. As people are starting funds, one of the biggest mistakes I make is a concession that they make because they think it's the right thing to do, not realizing that your job is to steward the capital and you're actually protecting the investor. And that is, we call gates, lockups, throttles, go through all the different kinds of those things and how we articulate them. Let's go with the simple one, a lockup, right? Everyone, I think, is relatively familiar with that, right? To be really clear what that means.
Does anyone not know what that is?
Also, you put money in a private fund, or a fund. Often there is a required time frame. You have to keep your money in that. You go to a brokerage, it's not like you go buy Apple stock and you want to sell it tomorrow and then go buy a car with it, and that's your money, right? No problem. When you go put $1 million in a fund, that fund's subscription agreement, right, its operating documents will tell you there should be, and we'll go over that, a lockup, i.e., you gave me the $1 million, you can't touch it for X amount of time. We're going to use a year in this example because that's a pretty common one that's used. I've seen some at 5, some at 10, some at 3 months, as in 5 or 10 years. And in fact, private equity, so you guys know, private equity funds, those are often always around 10 years. And the manager has the ability to trigger an extension, actually hold your money for an additional 2 or 4 years after that with some prerequisites. So your money could be held for 14 years in that situation, not uncommon. So let me explain that in a minute. First thing is, you would say, if you're managing a fund, the first way to think about that is probably initial reaction, that's terrible, because if I'm an investor, I don't want my money locked up. I want my money out. I want to take my money out if I want it. It's my money, right? It's possessive. You get possessive over it. How dare you have fees on my money for a year if I don't want to be in it? What I would strongly encourage you as a manager is to not make it a concession that you wouldn't have a lockup or these other types of things. Gates, throttles, we'll go over it. Here's why. It's not so you can clock a management fee. Sure, there's nefarious hedge fund managers on Wall Street that do this. Not what we're talking about here, right? Hopefully none of you guys are going in with that intent. The reason for the lockup is that you are protecting the investors, every one of them, not just you who put your money in for that incremental amount. Remember, you're pooling your money together. You put your $1 million in, 50 other guys put their $1 million, same amount, let's say, so I make the number simple, illustrative, $50 million fund, right? Well, what happens if the market, real estate market, right, has a temporary draw, a short-term drawdown that's significant in size, right? A lot of debt, but very, very fast. Market falls down 15%. Every one of the investors, those, I want out right now. What are they going to do, right? They're all going to say, I want my money out right now. The fund manager is not keeping the $50 million in there as he can't wait for his $500,000 fees to help offset the lawsuits that are coming in. It's not what it's doing. It's the fact is, if he has to get you your money out, if he then has to fire sell that loan, right, or that property, depending on the fund you're in, or the security, he has to fire sell it into a bad market. What does that mean? That means that loan's going to take, or that whatever that asset is, going to be discounted. If it's discounted, guess who that affects? Everybody else in the fund with you.
And God forbid you ever run on the fund.
Everyone. So there are multiple ways, again, lockups, gates, throttle, the lower reach, as Kevin's much better explained than I'm sure I would be. The idea is these are actually protections for your investor. And it goes back to say, another example, if your investors, not only should you never make that concession, but if your investor, prospective investor looks at you and goes, yeah, I don't want my money locked up, then if they can't understand, you should explain it to them, good, because they're probably not intuitive. Again, it's possessive, it's their money. After you explain it to them, why that lockup is there, why these provisions are there, if they say, like, yeah, I don't want you to keep my money locked up, that you wouldn't want them as your investor anyway, frankly, because they're not the type of person you want pulled in with you. I will add another last piece of this. How do you determine 1 year, 5 year, 10 year, 2 year extension, all of this? It's copacetic to your investment thesis and what you do. We chose a 1 year lockup. Why did we choose that? And our gates have other issues we'll get into. Because our loan tape, typical loan duration is around 7 months. They're written for roughly about a year, but people pay off early because you recharge a high interest rate with our type of thing. So a typical loan's outstanding and pays off naturally in 7 months or so, but it's out there for about a year. So we're very confident, pretty confident, that if everyone needed their money back, we would, at the same time, within 1 year, that portfolio should naturally turn. And if it doesn't, there's an extra protection. We had gates and other things, but that's why we chose that. Private equity, you said 10, 15 years. You guys, they are investing in companies that are hopefully worth $1 billion that today are 4 GPUs from NVIDIA in their mom's garage. Turns out that takes 10 years to develop an outcome. So that's why they're there. Whip, that was a long rant on mine, but maybe talk a little bit more about gates and why they're important.
I mean, they're essential, right? So the old way used to be 12-month lockup, best efforts, and that's really about it, right?
Best efforts, we'll try.
So the problem is best efforts is litigated, right? So when you litigate it, well, it's a reasonable man standard, and the reasonable man standard is always different than every judge and jury. So I don't like that methodology. I'm a much more like set the actual expectation in the documents. And so our common structures that we usually use is 12-month or 24-month lockup, depending on the lender. For most of them bridge lenders, right? So, these loans run for like 12 months, 24 months, sometimes 36 months. So we'll use that average maturity as kind of the lockup period. Then we'll do an annual gate. So an annual gate being that there's a maximal money that can leave the fund within a given fiscal year. And then there's going to be other features, like there's going to be emergency gate. The emergency gate is, so we use this during COVID. We can't value the assets because of the current market cycle or current downward trend that we're in. We need to be able to freeze the fund. We can't freeze operations and freeze exits, because if we let people out, we're going to lose money. But if we freeze withdrawals and redemptions, then we can redeploy capital and recoup some losses and so on and so forth. Because losses in these debt funds, they're not like these dramatic, huge swings. They're usually like, you'll maybe feel like a 5% loss on a book of loans or 10% loss on a book of loans. You can recoup that pretty fast with a new set of loans. So like, you need that ability, that capital preservation. And investors get pissed. You should be giving my money back. You shouldn't be lending. Like, well, no, we should be lending, because that minor loss that we took last quarter, we can make it back if we start making new loans. All right. And you want that. And they're like, oh, you're making fees. Are you sure we're making fees? A lot of times sponsors are going to waive their fees during that.
Totally climb. Yeah.
No. So these features are imperative. Another thing that kind of, take it or leave it, some clients like it, some clients don't, is the methodology in which the capital leaves the fund, right? So it's not just like lump sum. It usually is kind of paid over 4 quarters to minimize the cash drag paying up on the fund manager. There's a lot of other things, like, if you freeze the fund, how does the money leave once it's unfrozen and all that kind of stuff. But like, these features are really important. Not for the sponsor. It's really just to give the sponsor a few different tools to preserve the portfolio capital. Like, is the last.
Also, how Gerard put it. I mean, it's a protection measure for all of the investors.
So that's the hard part. Is like it's like vegetables, right? They don't want to eat the vegetables, and investors really hate these things. We try to
I think the moral of the story here is you shouldn't have to sell your investors. You shouldn't have to sell and to raise capital. You have to stand it and the protection measures that are in place for them.
Build the ark before the storm. Yeah. And that's the whole point of
But you look at there's a lot of funds out there in private lending. They're like 15 years old, 20 years old now. And the average life cycle of an investor in those strategies is a minimum of 5 years. Even though the lockup's 12 months, the average life cycle is around 5 years. And some of them are even longer. The biggest fund here in the Valley, the average life cycle has been 7 years. So like, why? Because it's supposed to be an illiquid investment. This is an illiquid strategy. This is real estate.
Mike Fountain told me the average K1 in America actually lasts longer than the average marriage now.
So, America. Just real quick, dovetailing off of Gates, akin to that is concentration risk, both on the borrower side, how much concentration you have in one borrower or borrowers. I think I mentioned yesterday a big issue up in Canada where a mortgage lender invested too much of her portfolio into one single investor, and he went bankrupt, and then she had to go into receivership, right? It was a big concentration risk of hers. But there's also concentration risk on the investor side. I think a lot of people say, well, I'm just going to set up a fund and throw 2 really big investors, or I always want to land one family office. But how does concentration risk factor into this, and explain to them what did that mean?
Well, huge, right? I mean, and I can give you an anecdote and that's one recently. You think about it, because pooled investment vehicle, right? You don't want to monolith. The example I gave everyone here was that triggers would be pulled in the fund to protect it, right? The arc before the storm, because the market all went in one direction. Okay, that is when that's why you have those protections. There's another one though, that you don't also want, which is any individual, any idiosyncratic risk of a singular person or a handful of people, like a little oligopoly, if you will, being able to do the same thing. And so from that standpoint, we don't let, and everyone, it's a little bit arbitrary and come up with this number. We don't let any investor come in across all their accounts. Doesn't matter if they have a Roth plus a trust plus the entire client as a whole, that relationship or relationships by proxy we do not allow it to be over 10% of the fund, right? And I look at that again and go, because same idea. What if the market's going great, but he gets a nasty divorce? Do I have to now fire sell assets?
I had that happen. The fund was comprised of 5 guys, all really big ticket investors, and one of them got into a nasty divorce.
Yep.
And basically sued his way up, and we had to wind fund them.
Yep. We had, and I'll give you an example of, and you guys say you're probably crazy, or it really does happen. We had a client who we've known for a while. This is a friend we've known for a while, has a large asset base that he made in crypto and things like that. And he wanted to set sails with his significant other. He wants to be out of that business. He made enough money at a young age, enjoy their life with their young kid and go do amazing things. Great. Sounds like an amazing life, which I had. Anyway, he comes to us, he's like, hey guys, I want something more passive. I've been an active trader in crypto. I want something passive. Can I send the fund your way? And, he knows well as a book, let's do a discovery call, make sure we check our box and go it all. I'm like, great. Our funds are on 45 million. I'm like, great. Looking at what we could possibly even deploy over the next 12 months. What makes sense? How much would we take in? I'm thinking, yeah, we could do $500,000 now, maybe another $500,000 in a month is what I was thinking. I'm like, so, client X, I go, what are you thinking? He's like, yeah, I'd like to put in 10. Can I wire it tomorrow? And I'm like, no, 10 what? 10 million. No.
Problem to have.
It's a good problem to have.
Scary.
But you guys, again, don't be penny wise, pound foolish with this. All assets, regardless of size, are not good assets. All clients are not good clients. It will create massive problems down the road for the incremental fees you're getting up front for these things. And I was only told him, no, hey, but the loan, put $1 million in, which he did. The loan tape builds, everything goes great. And you go from, your sales go from this continent to this continent. I'll give you a phone call, dial out, wire the next $500,000 in, right?
He'll definitely be the first guy we call. Yeah. Oh, what baby?
Well, that's the methodology, right? And I hear this a lot. I've landed this big ticket investor. What do I do? Trickle them in. Please trickle them in.
Yeah.
Do not take it all at once, because you're going to be burning. You're going to be chasing dog shit for a long time if you do that. But on the flip side, when a fund's getting started, a different approach is that if you find that what I call anchor investor, and he's going to help you, I would actually partner with that. Mm-hmm. So give him a stake in the GP co. And there's a reason for that, because concentration risk. If things go sideways, he's going down with you. And he knows that.
And Kevin, you can put special provisions around him too.
Of course. We can put all kinds of special provisions around him, lock him down, lock him up, prevent him from, seizing the business. We can do all that kind of stuff. But the idea is on the anchor side, is I prefer to have the anchor investor have a stake in the opco, because that will make sure that if we have concentration issues because of you're not going to come and try to kill us because you own a piece of the opco.
He's suing yourself?
Yeah. Yourself. You're not going to sue yourself, right? Yeah. And you also get to deploy. You're going to deploy resources to help us, which is going to be important.
I'm going to add more of that. I think anchor investor, incredibly important for a lot of startup funds, because what we talk about, you need things like administrative costs, audit costs, all these things rack up, and you're not going to be able to take a fixed cost of $40,040 and another $200,000 and spread that out in an efficient manner over your $5 million, and then maybe next year $6 million or $7 million. It would be such a drag on performance. You're never going to raise enough money. So what happens is you'll get these anchor investors who come in, they get a little bit and they can argue different, there's a lot of trade-offs you can make. Hey, I'll put the first 10 million in, right? Which you helps amortize out that $100,000 to 10 basis points. So it's not horrible, but in exchange, I'm only going to pay half of the management fees everybody else would pay. Or in exchange, I get 30% of the general partnership, right? So these relationships do exist. These trade-offs do exist. And I think back to, most of the people you talk about starting a fund, your biggest issue, for a lot of people, it feels like is raising the initial capital. I don't know if there's a better, more try and true path than having an anchor investor and negotiating. It's probably number one.
It gives you a lot of peace of mind, helps, especially if you're going to do a lot of volume.
And what do you suggest for private debt? 5, 10, 15? What's kind of that range for you?
Depends on the monthly volume. So if let's just do an example earlier, $30 million a month lender, and I'd probably say Like I would want to see a minimum within 10 to 20.
No one's a $30 million a month. How about $3 million?
Well, fine. Yeah, I'd probably want to see about $5 million.
Of anchor capital. Yeah.
Well, is there any other questions? I mean, I know we have a break starting now, but is there any final questions? We didn't even get to scratch the surface on the legalities of using others to raise capital for you, but
Don't do it.
save that
Broker dealers.
and
Broker. Don't mess around with that ish.
At what size? At what size would you guys recommend some of the startup funds? And then what are you guys do an idea of what the expenses are at that point? Like, when do the expenses make sense with the size?
I think what you said earlier is probably the best reason.
I think Devon came in after the fight.
So basically, when deals are falling apart in your current methodology, or if this capital constraint, or it's inefficient, or like your reputation is being hurt because your investor is supposed to fund that deal, he just can't be found, or he's on some island somewhere. Like, guys, you're killing me here, right? Like that kind of issue is the number one reason why clients will lower. This is why there's not a sweet spot number, right? Like everyone's different, There's another factor to it though. It's like if the capital that you have at your disposal is more akin to a fund structure, sometimes it just makes sense to jump into that, right? Because depending on what market you're in, like in Texas, for example, Texas is a very popular fund state. It's because the majority of capital who invest in private lending in Texas comes from the oil and gas world. And they're used to going into funds. They're used to going into syndications. It makes sense for them. They understand how to be an LP. Whereas, like, for example, in Washington, it's actually very common to be a trusted investor. It's hard to overcome that, I guess you call it stereotype, right? So that's another reason.
And will you read a fund manager like Gerard from the get-go? Do you read like the software? Like I've heard there's like fund manager software.
Not all the time. Everyone's different, right? Like
I think it depends. One thing that Gerard touched on earlier before you got here was just really doing a deep dive on your competencies and skills and your desire and propensity to manage some of these things, right? Matt and I knew this was something I would never totally understand, right? And I just needed somebody and that peace of mind to know that we could carry this on and I can go and take a vacation and this thing isn't going to go to shit.
And corresponding.
And then you heard him talk, then dude, I found like a gold mine.
I love this stuff. Correspondingly, there is no, I don't know if there's a job, I think very one I can name in this world I want less than Kevin's, right? So I was not over. There's certain people, different sorts of different folks. They find your core competencies, right?
I mean, he's a 6 foot tall Korean. Like that's rare enough as is.
It's just a cool annoying.
She writes books. I don't even read books. Look, so we all have these. I don't want. You're gonna yell at me, so please don't, Kevin. I don't want to throw a number. I'm kind of doing it, but I don't want it. In the public markets, which are different, the fund structure that was around for a long time, that feels like, what's that? Because it's always that, just give me a number, right? You don't want the truth is what Kevin says, like everything is incredibly dependent. The number that used to be tossed around was 10 million for a garage band hedge fund.
Yeah, all right.
And that was about, and what that meant, and they'd say is, okay, shit foundation, 100 grand to run. That's 10 basis points of performance. That's not going to kill you on operating costs on 10 million. 100 grand for expense annualized on a $10 million fund is a garage band hedge fund. That does not mean you should do it. And that is not the same world that we're talking about.
Rough numbers, there's kind of not much. You can do it for less, you can do it for more. Like, it depends on who you choose. If I were to advise, knowing who you are, like, and your ability to raise money, like, I would say those numbers probably line up, except you might want to spend a little bit more on the ops, because you have a really lean team right now, right? And so that's the challenging issue. And so, like, OpEx is going to be a little bit higher, but you have to get comfortable with that. And that OpEx is going to be worth it because you're going to be able to raise, like, I think you can raise serious money. So the OpEx,
that or if it's going to fit his lifestyle too. I mean, he's very conscientious about ensuring that this matches up to his lifestyle, not growing this into something ginormous, right? So I think it depends on your lifestyle too. And it's a lot harder to unwind a fund as it is to just roll back on your trust deed investment.
That's very true.
Right. So we raised up, we're funding up to 50, 60 million a year just in whole trust deeds. And I'm not saying, because if I didn't roll into a fund, I would never met Gerard. But it's a lot harder to consider retirement now or future semi-retirement with Matt when you do have things in a fund, because we do have a lot more overhead than we did before. You don't have that much overhead when you're doing trust deeds. You don't have cash drag. You don't have any for a fund administrator,
Commitment to your investors too.
and a commitment to your investors.
They made this decision probably for 5 or 10 years too. There's a commitment there rather than implicit.
I mean, attrition to us at this point is like the ones that, I mean, that they're going to die off, right? I mean, honestly, they've been with us for a decade and they're in their 70s or 80s. Like, it's imminent. They're not going to lead any other reason. So at this point, I feel like an ethical responsibility, the steward of their capital. I'm not just going to redeem or close it up shop because I want to go, travel the world on a cruise ship. Doesn't feel right to me. So there's a lot more considerations as a lifestyle business, and you can still do it very effectively as a full trustee broker with no overhead. Beautiful day, right?
Arizona's a little harder. The licensing here is a little bit harder. Yeah. But like what you're doing is scalable right now, and it'll be lifestyle. I'll refer you to a friend of mine here in the Valley. He has the only lifestyle fund that exists. And it's all country club buddies. And he's making it work, And so he's got a skeleton crew behind him. He works like 20 hours a week, and he plays golf 40 hours a week. So
Golf the number.
So I kind of just started out pursuing private money here doing whole note Blaze Street, and I did my first loan a couple months ago, and starting to get decent deal flow with potential loan opportunities, potential borrowers coming in. I have friends and family capital, one of my own capital.
yeah.
What's my route to get to 10 million in simultaneous loans as far as legals and raising capital? What pitfalls? What does the next 3 to 5 years look like for me here? 12 months.
I mean, the origination block business, right? That's the primary, right? How you fund your loans. I think this week you've learned about a multitude of strategies.
Yeah, whole note placement.
Great way to do it. Easy way to do it, right?
Definitely not as fun in your 3 to 5 year trajectory.
Yeah. The volume is there. If the volume is there, it might be worth it, right? So everyone's different. I have clients that their background just led to just a flood of loans. So that it happens. But really, I would say in 3 to 5 years, you're building the operations, you're building the origination business. You're building the brand.
And what about on the capital raising side?
Continue doing that. The whole loan, right? Whole loan's great, man. Like it's easy to you can transition to it. Devon's doing. It's really easy to do that, right? Focus on for the notes, like accredited investors. It's really easy.
So I go out. My game plan is to kind of position myself as a private money lender, educator, and do like in room, have luncheons like this with with individuals.
Works really well.
I'm okay to do that.
On whole note, yes. On fractional,
yeah.
On the company notes, investor notes to your company, the answer would be yes. If they are accredited, and if you're not outright like soliciting the note programs. Like you can pro out the business first, and then find out about them, and then offer the secured.
Right. And so I'm even okay going out on social and saying this is what I do, but not
promote the business all day long. Just don't offer the securities or float securities online.
Share your story. That's it. Sorry to break us up, but we have another session starting in our. Thank you so much to our panelists. Thanks for getting up.